The 60-40 allocation is dead, and the 3-bucket strategy is the strategy you should be using for your retirement portfolio. You've probably watched videos like that and telling you all these different things. What I want to explain is that potentially the 60-40 is not dead, and I'll show you exactly why, where bonds have been, where they are possibly going from here. Then let's talk about this 3-bucket strategy, because that really does come into play with all of this. If you're thinking through having your short-term bucket, your mid-term, and your long-term bucket, how that could all work, or maybe something else that should actually work better for you. So let's take a look here at the screen. Looking at this, AGG is in orange. That's your iShares Core U.S. Aggregate Bond ETF. When I'm talking about the Aggregate Core Bond ETF, it's not just government bonds. It's not just high-yield corporate bonds. This is a very diversified basket of bonds broken up in this portfolio. Then you have the purple line is the NASDAQ, the blue line is the S&P 500, and the yellow line is the iShares Russell 2000 ETF. So looking at this scenario here and breaking it all down, we're looking at 2008. So in 2008, this AGG fund was up, roughly 7% and down nearly 7% as well, which actually put you in about a 14% loss from, this high point here and down. But then if you look at the actual market, we lost probably 50% in a lot of these portfolios. So would you rather be down 50% or 15%? Now, sure, the growth here is a whole different scenario, because if you actually look at, let's just say the past 20 years, you can see what the NASDAQ has done versus AGG, this little old guy down here, not doing much. It doesn't look like it's really done much, but what we've got to talk through is hedging your portfolio. How much risk do you need to take? And if the bonds will hedge the portfolio, what it's going to allow you to do is potentially pull from those if the market were to take a downturn. So now let's just take a look here again at, what was going on in 2020 and also in 2022, because that's where the 60-40, portfolio is dead came from. So looking in 2020, again, you can see in 2020, the markets rallied up and then fell drastically, though you can see in the back there, the AGG fund, and I'm not telling you that that's the fund to go with. This is just oftentimes a benchmark for bonds. This did not fall near as much as the overall market. Again, looking here, though, it didn't do anything when it came to really significant returns. It actually fell quite a bit in 2022. And if we look at that in a little bit more of a zoomed level, we can see all the way back 21. And when the Fed started to raise rates, what happens is the bonds don't become as attractive, and new bonds are paying higher rates. So people are going to flock to those. So these bonds that were diversified with a bunch of lower paying rates, because really from 2008 all the way up until about 2021, rates weren't that high. And so as the Fed really aggressively raised these rates, all of these old bonds, 10-year bonds, everything else, were not paying much. They were getting just hammered out there. And so that's what's coming into play here in this chart and what we're looking at. But then, we do have, in the past year where bonds have kind of started to stabilize now, even come up quite a bit this past year. But really, where are they heading? That's what I want to talk about. And so let's just go over here. I'll talk about this on the Handa board and talk through it. And so when I'm talking about the 60-40 portfolio, as I mentioned, you've got 60-40 stocks and bonds. Let's write this as bad as we can, so then maybe you can't read it. But so we've got stocks and bonds there. And so when we're looking at this, we'll have, let's just say on your bonds, you could opt for individual bonds, or you could opt to do ETF or maybe a mutual fund. So with the individual bonds, what people are doing is the individual bonds, they're actually looking at buying individual bonds. You can go out, you can buy these individual bonds that are just like the first offering there, or you can do what's called the secondary market. Oftentimes you're buying on the secondary market. So you're going to go out here and you're going to buy this bond. And when you buy it, let's just say that you buy a bond for $1,000. Well, then they're basically going to say, okay, we're going to give you, let's just say 5% on your money. And on that 5%, they're going to pay you that for the 10 years of the bond that you purchased. And then at the end of the 10 years, they'll give you back your $1,000. So you're getting 5% every single year on your money. Sounds exciting. The one risk that you run, though, and something that I've seen because we've helped clients get into individual bonds, is diversification. That's where it comes into play that you have the ETFs and the mutual funds. They don't have a maturity date. Like, let's say if you bought a 10-year bond here, at the end of 10 years, you get your money back. Instead, it's a little bit more of a very liquid option that you can get in, get out at any time, though you do run the issue of the volatility of the bonds and not actually possibly getting all of the principal balance back. Though, if you look at the history of bonds, generally speaking, they do go up, just not near as much as the market does, but they also don't generally fall near as much as the market either. They're oftentimes a hedge. And so the ETF mutual funds allows the opportunity for diversification and liquidity, though the one problem with these is they do have expense ratios. You are going to have some different expense ratios, but you do have a lot of these fund managers that have started to cull the old bad bonds or the bonds that weren't paying much. And so that you saw that 2022 big drop in the bond market, but then now they've started to put in better bonds or bonds that are paying higher interest rates. So as the Fed starts to lower rates, which is, as I'm recording this in September of 2024, the Fed hasn't lowered rates yet. Once they lower rates, what's going to happen is the bonds that are already out here that are paying a higher interest rate are actually going to go up in value. And so that's some good opportunity there. But what we saw in 2022 was the Fed was actually lowering or raising rates. As they were doing that, the bonds that were already out there were now going down in value because they were bonds that were higher interest rates. So then when that comes into play, well, the bonds that are already out there are losing value. So as the stock market was falling down, so was the bond market. So it was a kind of a lose-lose situation. But now coming up, the Fed's going to start lowering rates. That's going to create an opportunity. So even if the stock market does go down, potentially the bond market will stay steady, maybe dip a little bit as we saw previously, but not near what we had prior. So that's what we've got to look at. And that's where I'd start talking about the 60-40 allocation and potentially having some opportunity. Now, when I say 60-40, it doesn't mean that that's specific to your portfolio. You've heard of people say, well, when you're 50 years old, you should be at 50% stocks, 50% bonds, or whatever all the silly rules are. I don't say that at all. I actually get frustrated when I hear those stories and how you should be positioned at a certain age. What it really comes down to is a financial plan. I've done so many financial plans with people and started to look at these with clients and showing them exactly how they need to invest for their goals. Now, you do have to look at risk tolerance and how much comfort you have. If you're 100% in the stock market and you don't need any money, well, that's okay. That's great. Maybe you don't need all of that risk, but also can you stomach the downturns? That's what we want to look at when it comes to the risk tolerance. So you've got to figure out what works for you, for your goals and your risk. So just talking through that in general. But where does this all go now with this bucket strategy that I mentioned at the beginning? Well, we often have heard of bucket 1, bucket 2, and bucket 3, and having basically short-term money, mid-term money, and then long-term money. And what would end up happening is people would say, okay, I'm going to have my short-term money. That's what I'm actually pulling from, and that's going to my bank account. Then I'm going to take this mid-term money, replenish my short-term, and then I'm going to take the long-term and replenish my mid-term. It sounds great. What ends up happening, though, is it's a very complicated process. And yes, you could try to strategize and be the perfect market timer, which we all know we aren't supposed to do, and say, as long as the market's going up, I'll continue to replenish and eventually have enough money in my short-term bucket that should carry me for a while. Well, if they were talking 2008, that could have been 5 years. But generally speaking, maybe a couple years for the markets to recover. But you have to be very careful with this strategy because a lot of people, what ends up happening is they're pulling from their short-term money. Well, then as the market's falling, they're going to have to still sell off from their mid-term bucket to put in their short-term. So they're still selling low. Then they're going to take from their long-term bucket, sell more of that to put into the mid-term bucket. And again, they're just selling at a lower cost and not actually meeting the goals of what they have. So the 60-40 or anything like this, it does not have to be the 60-40. It depends on, again, your goals. But you've got bucket 1 and bucket 2. It's a 2-bucket strategy. And that I do feel is what's coming back as the Fed starts to lower rates. We have to be careful. It's not something that I'm going to say is a forever thing that we need to be looking at because, if the Fed starts to raise rates again, got to be very careful with these bonds or we may see a repeat of 2022. But as it sits with the Fed starting to lower rates, if you're allocated in a portfolio and the stock market starts to go down, well, your 60% over here is going to go down. But hopefully your bucket 2 isn't going to go down as much. If you've got this bond strategy over here, or more conservative, maybe you've even got a little cash in there, what you could be doing is now pulling from this bucket when the market's down. But when the market's going up, you're pulling from this bucket. So it's a 2-bucket strategy that allows some more simplification. It's not this overcomplicated thing like the 3-bucket strategy and trying to nail down how exactly it's going to work. I've had clients who have done that. We've tried to help them through with the 3-bucket strategy. And the more I've done this, the years of being in finance, I realized It's not an easy process, and it's never going to be perfect. This is a much simpler process, and I had a friend tell me one time, keep it simple, stupid. And so, just thinking through that, honestly, that's what somebody needs to be looking at and considering, is going back to the 2-bucket strategy, because the 60-40 is not dead. So I'm said a lot with this video. I'm curious as to your thoughts. What are your thoughts on this? Maybe you think that I'm crazy, and if so, I'd love to hear about it in the comments. But I'd like to know what you're thinking and what you're planning as well for your retirement portfolio as the Fed starts to cut rates.